In the world of investing, diversification is like having a safety net. Imagine putting all your money into one stock. If that stock tanks, so does your entire portfolio. That's a huge risk. Now, let's break it down. When all investments are concentrated in one asset, the volatility can be nerve-wracking. Market fluctuations can turn a promising investment into a nightmare overnight. A single bad decision or unforeseen event can wipe out savings. On the flip side, spreading investments across various assets, stocks, bonds, real estate, or even commodities, can cushion against those unpredictable market swings. This strategy helps to balance risks. If one investment falters, others might thrive, keeping the overall portfolio stable. Think of it like a balanced diet. Just as eating only one type of food isn't healthy, relying on a single investment isn't smart. A diverse portfolio can include different sectors, geographical regions, and asset classes. This variety can lead to more consistent returns over time. Moreover, diversification can enhance potential returns. By investing in a mix of high-risk and low-risk assets, investors can capture growth opportunities while minimizing losses. For instance, while tech stocks might soar, utility stocks can provide steady income. Another benefit is the peace of mind that comes with knowing not all eggs are in one basket. Investors can sleep better at night, knowing their financial future isn't solely dependent on one investment. It's also essential to consider the time horizon. Younger investors might lean towards riskier assets for growth, while those nearing retirement may prefer safer, income-generating investments. Adjusting the portfolio according to life stages can optimize returns and reduce risks. Furthermore, diversification isn't a one-time task. It requires regular review and rebalancing. As markets change, so should the investment strategy. Keeping an eye on asset performance and adjusting allocations can help maintain that balance.